We're here to talk about how a volatile market with options can yield opportunity. And if we take a step back, yes, a bull market can be fantastic with empirical testing and trend following, and it has in fact been rather fantastic. But it turns out that a volatile market can be a once-in-a-generation opportunity with less risk, and now is the time to show that. We will demonstrate it explicitly and empirically. From this point forward, every strategy we're going to look at has worked during both the Great Recession, so 2007 to 2008, when the S&P 500 collapsed, and over the last 6 years, so during a raging bull market. We are looking for robustness of strategies that work across time frames and markets, and everything we are going to demonstrate today is empirical. This is objectively observable fact. But before we even get started, there's something we need to touch on. I kid you not, that by the time we are done, you will be such an expert in implied volatility, even if you don't know what it is at this very moment as you're listening, that your eyes are going to start to glaze over the results. So here's a sneak peek. While your eyes are still fresh, we are going to see strategies that during the bear market, we're going to see bullish positioning in short bursts of time, where a stock like Cisco was down 24%, but the bullish option positioning was up 137%, or Intel was down 37%, but bullish positioning with options was up 140%, or Nvidia, yes, Nvidia, was down 72% during the bear market, but bullish positioning during the bear market returned 74%. And then we will look at non-directional strategies, where Microsoft was down 33% during the period, but the non-directional strategy was up 65%. Or GE was down fully 55%, but the non-directional strategy was up 171%. And at the end, we'll even look at a strategy that lasts for 3 days, 4 times a year. That is 12 days of trading a year, where Disney during that period was down 1%, and this 3-day trade was up 145%. This is what we're about to see. But before we get to the results, we have to gain the knowledge. Everything we do here is empirical, but this, right now, is the one time we're going to introduce opinion, and we're saying it explicitly. In our opinion, to navigate a bear market, you need 2 things. You need empirically tested timing based on implied volatility, and we will dive into the subject of implied volatility. The second thing to navigate a bear market is to have a risk exposure for short bursts of time rather than extended strategies. This is our opinion, and we will move forward in this webinar with this opinion using empirically based fact to support that opinion. This is what we're going to cover. We're going to start by learning the constituents that comprise an option price, the relevant constituents to short-term option trading. We will quickly see that option trading is volatility trading, whether we mean it to be or not. We'll then get into real-world examples of these constituents in practice. We'll then talk about earnings and implied volatility. We'll then talk about something called theta, which just means time decay. But we're not here just to provide education. We're not here to talk about stochastic differential equations, partial differential equations, Newtonian calculus, or Ito calculus. We're here to take the relevant parts of education in options trading and then apply them to actual strategies with empirical results. This webinar is designed to discover strong trading strategies. Before we get to it, let's take a quick break to make time 2 definitions. The first is implied volatility, or IV. That is the option market's reflection of expected future volatility for the underlying stock. That is, implied volatility is forward-looking. It's a forecast. You could even call it a guess. Historical volatility, or HV, is the actual realized volatility for a stock over a period of time. For example, the HV 360 would be the historical volatility a stock has had over the last 360 days. So to be perfectly clear, IV is always forward-looking. It is a forecast, and it is provided to us by the option market. Because of that reality, the implied volatility for the day of earnings is much higher than a normal day. That is, the forecast of volatility on the day of earnings is obviously higher than just any normal trading day, and that makes perfect sense. It's earnings days where we have a known event that could quite possibly move the stock abruptly, one way or the other. So just remember it. It's coming back. Implied volatility is extraordinarily high on the day of earnings. So let's start with the learning. The constituents that comprise an option price. Well, there's the underlying stock price. There's the strike price of the option. There's interest rates, dividends, implied volatility, and then the time to expiration for the option. For the sake of ease, instead of writing all those words, we'll call the stock price S, the strike price K, interest rates R, dividends D, implied volatility V, and the time to expiration T. So what makes an option price? We'll write it like a math equation. We'll define O as an option price, and the constituents that define that option price are stock price, strike price, interest rates, dividends, implied volatility, and time to expiration. But in the short term, so we're talking about 2 weeks or less, we don't need to focus on all of that. It turns out that interest rates over a 2-week period have really no impact on options, and so we're not going to get into the weeds of options education and talk about something called a row. We also don't need to worry about dividends as long as no dividend is going X during the 2 weeks of the strategies that we're looking at. So now we've reduced the constituents that really matter to us from 6 to 4. Even further, we're going to be talking about non-directional option strategies, and that means we also don't have to look at the stock price, and we don't have to look at the strike price because we're going to be looking at the money options. And that reduces our problem to one that is much easier to comprehend. We are going to discuss the impact on option prices of implied volatility and time to expiration. Just to make it fit our shorthand, an option price, as far as we're concerned, in the short term, is based on V, the implied volatility, and T, the time to expiration. And this does quickly lead us to the reality that option trading is volatility trading, whether you mean it to be or not. That is, even when you take it down to the simplest constituents, even for short-term option trading, volatility is one of the main drivers to option price. It's this fact that will further our education and lead us to where we're trying to go. But seriously, option trading is volatility trading, so we're going to need to dive deep into that subject. We can observe some real-world examples of these constituents in practice. Let's take 2 stocks. These are actual market values. A stock, ticker DQ, had a price of $50.13. Another stock, UNM, had a stock price of $50.58. So the stock prices were pretty similar, but they had very different implied volatilities. DQ had an 81% implied volatility, and UNM had a 27% implied volatility. So let's see the impact of this volatility on option prices. Again, these are real-world examples. These are not contrived. Here's a summary of what we found. Here are the 2 stocks and their prices. Here are their implied volatilities. Here is the difference in the price of an at-the-money call option. Even though DQ had a lower stock price than UNM, because its implied volatility was 3-fold, the call price was more than twice as expensive. Remember, these stocks had the same price, the same time to expiration, and a different implied volatility. The option prices are wildly different. For those who like to check the facts, this is actual market data as of February 7th, 2018. The options we were looking at were the March 16, 2018 expirations. We were looking at the 50 strike calls. Remember, option trading is volatility trading. We repeat this so to motivate the next portion of this presentation, which is to understand the guts of implied volatility and how that's going to help us identify strategies that have worked in the past. We've already looked at implied volatility, but we said that an option price in the short term also depends on time to expiration. Since options have an end date, they're always decaying in value. That is, they're becoming less and less valuable over time, all things being held equal. That time decay is called theta, which is actually a Greek letter. But theta, that is, the amount that an option is decaying over time, is not a straight line, and this is critically important to identifying successful option strategies. In fact, if we were to plot the time decay for a 7-day option from the day it opens to the day it expires, theta actually decreases in a curve, and eventually, of course, goes to 0. It's this point, this inflection, that is important to us and is what we were going to address as we move forward. Even more so, when we're looking at the money options, time decay acts very differently than it does for in-the-money options. So this red curve is at the money options, and it's this inflection point right here that we want to identify. In-the-money options have a very different linear decay. Now we're going to move on to learning and not just observing. We'll talk about earnings and implied volatility. People like to say implied volatility rises into earnings. That's close, but not quite true. But there's something very unique about the day of earnings that matters to trading. Let's take an example. This is for NVIDIA. This is real market data as of February 2018. NVIDIA had a historical volatility over the last year of 45%. The implied volatility of the January 2019 options was 47%, and the implied volatility of the January 2020 options was 45%. In other words, the far out options tend to have the same implied volatility as the stock has actually moved. Remember, implied volatility is forward-looking. Historical volatility is what actually happened in the past. This phenomenon helps us understand the impact of earnings. With an HV360 of 45% and the implied volatility of the further out options very close to that number, we can take a snapshot of NVIDIA implied volatility. NVIDIA had earnings on February 8th, 2018, and the implied volatility of the February 9th options, that is the options that expire on February 9th, was 196%. So here are the January 2020 options with a 45% implied volatility, very similar to the historical volatility. And here is the insane implied volatility of the options that have the earnings event. So why is this happening? We could even take a step back and look at the February 16 options, which have the earnings event in them and another week. Let's focus on them. How do we get to this 86% number? What does it mean? And when we get there, why does it help us? We know that the options expiring on February 9th, which is a Friday, had the earnings event, and the day before earnings had 196% implied volatility. Somehow, when we add the rest of the week for the February 16th options, we end up at 86%. How does that happen? Well, if we plug in the historical volatility of NVIDIA, for each day after earnings, we actually end up with an implied volatility of 86%. That's the magic of pricing volatility. You take the vol of the event, which is earnings, one day, 196%. You take the normal vol for the rest of the days, 45%, and you end up with a total expiration volatility of 86%. For those of you that are checking the math, you cannot just take the average of these numbers. These are standard deviations, but that fact is hardly relevant to the point, which is that option volatility can be priced with historical volatility and the volatility of an event. Now, why do we care? Well, we know the day of earnings has huge implied volatility, and we're getting really close to applying this in the real world. We're almost there. Just need one more step, which is the relationship between implied volatility and time decay. Because remember, in the short term, the option price is determined by these two elements. It turns out that the implied volatility can reduce the negative effects of theta, of time decay. But instead of showing you a math equation, let's just try some common sense. Let's imagine that NVIDIA has earnings in 2 days, and the options expire in 2 days. Let's say the straddle today is $18. How much less would that be worth tomorrow when we know that earnings are 2 days from now? The answer is the straddle would be worth about the same. So just with logic, we can see that implied volatility can reduce the negative effects of theta, of time decay. And so we said the graph makes sense. Actually doesn't make sense the way it's drawn. If the at-the-money options are short-term expiration, and at the end of that expiration, they have the earnings event, it would look much sharper of a drop on the day of earnings. But until then, theta decay would be less. And that is precisely what we're looking for. So what we have learned here, and what the point of this entire exercise was to explicitly see that if we own options which have the earnings event in them, we can see reduced time decay before that event. And that means the long options will go down in value slower than they normally would have. And that is precisely what this chart is showing. As you look at these circles, normally we would have seen this much time decay, but now we will only see that much time decay. And that is critical as we get to our first actual implementation of a strategy. Now we know the day of earnings has huge implied volatility. The relationship between implied volatility and time decay, which is that implied volatility can reduce the negative effects of theta. And now we know why this matters. Options, with all else equal, will lose value from their time decay slower as we approach earnings. That means we now have a strategy to backtest. The first one we're going to look at is a pre-earnings straddle. Let's talk about the logic first. The idea would be that owning a straddle that has the earnings inside of it will reduce the effect of time decay because of that earnings event. We want to see the results of buying an at-the-money straddle a few days before earnings, then sell the straddle just before earnings, so we never face that time decay collapse. The goal is to benefit from a very short time frame when the stock might move a lot, either due to earnings anxiety or earnings optimism, but to reduce the negative effect of time decay and take no actual earnings risk. This strategy is totally immune from a bull or bear market because it is non-directional. And that's the key. So this is how the strategy looks. An earnings date is a week away. Over here, we open a long straddle 7 days before, and on the 6th day, we close the trade before the earnings date. We just did a lot of work, and now it's time to reap the benefits of that work, applying it to an actual strategy for trading. Now is the time to turn to empirical results. For the purposes of this study, we used the NASDAQ 100 and the Dow 30 stocks over the last 6 years. If we just held a weekly straddle and rolled it every week, that's clever because it takes no stock direction risk, so it should be great in a bull market and a bear market, except for one phenomenon, and it's terrible. That's time decay. In fact, time decay had such a negative impact on this plain vanilla straddle that the win rate was only 28%. Or said differently, this strategy over the last 6 years, every week, lost more than 70% of the time. But we are taking the knowledge we just acquired, and we're looking at a pre-earning straddle, knowing that if we include earnings in our straddle, we have a stopgap to time decay. This is appropriate because it takes no stock direction risk, so if we hit a bear market, we'll do fine. If we're in a bull market, it will do fine. But it's also smarter because we have decreased the impact of time decay. And empirically, we have shown that the win rate goes from 28% to 60% because of this clever knowledge and use of implied volatility surrounding earnings. Not only that, the total return is more than 2 times higher using this pre-earning straddle, which makes use of implied volatility and decreases the impact of time decay relative to the standard straddle. We're going to look at this first strategy, this pre-earning straddle. We will look at it in Trade Machine Pro. We'll look at the 2 largest companies in the world, Apple and Google. We'll look at the largest media company in the world, Disney. And then we'll look at the largest biotech in the world, Gilead. We're not even cherry picking. We're simply looking at the 4 largest companies relative to this base. Here we go. So we enter our tickers, Apple, Google, Disney, and Gilead. We click on a straddle. We want to test getting long. We go to Custom Earnings under the Earnings Handling section. And we apply what we learned. We look to open the strategy 7 days before earnings and close the position 1 day before earnings. We are not looking to take the earnings risk. We are looking to use the earnings implied volatility as a backstop to protect us from time decay, while also looking at a strategy that works just as well in a bull or bear market because it takes no stock direction risk. And here are the results. Here's Apple. It has won 12 times out of the last 20, returning 56%. Google has won 10 times out of the last 16 with 135% returns. Disney has won 11 times out of the last 20 with a 79% return. And Gilead has won 11 of the last 20 with a 105% return. But there's even more going on. If we tap on a backtest tile for Google, we can see the average winning trade was 20%, and the average losing trade was only negative 4.8%. And while we're here, we note that this strategy over the last 5 years has returned 135%, relative to the stock returning 157%. But this took 5 years of a holding period, and this strategy only traded 4 weeks a year, or in 20 weeks, 135%. And it didn't matter if the stock went up or down. This strategy is stock direction neutral. And so here is a summary, all of the trades together for these 4 stocks during these 5 years. And we can see the win rates, the average wins, the average losses, and the total return. And what do we see here? The average win is twice as large as the average loss, 21% to negative 10%. The average loss is very well contained. This is a strategy where when it loses, the average loss was just 10%. The win rate, for every 7 trades, we see more than 4 wins. That's a 58% to 42% win to loss rate. And the total return, a 94% total return over 5 years without ever even taking stock direction risk. It doesn't matter if we were in a bull market or a bear market. This is the application of our knowledge. We took no stock direction risk. We reduced time decay. The earnings date acts as a protection mechanism for theta decay. The trade never took on the risk of an actual earnings event. The trade closes before the earnings ever occur. All right, we're through the education part of this, and now we can go faster. The first question we need to ask, what happened the last time we were in a bear market? Here's the S&P 500 from 2007 through 2009, and of course here's the Great Recession from 2007 through 2008. if we simply held a straddle and rolled it every week with no other rules or intelligence, for those 2 years, because volatility was so elevated and the options were so expensive, the win rate was unbelievably bad. In fact, if you took all of those 130 companies and you looked at their 100 trades over those 2 years, only 4% of those companies showed more wins than losses in this weekly rolling straddle. So no, owning volatility blindly in 2007 and 2008 was not a winner. And we don't mean that subjectively. We mean that objectively. It's empirical. These are the results. Now let's look at our pre-earnings straddle. The win rate was only 50%, so not quite as good as during the bull market, but the average return was 12%. Now let's go to Trade Machine and we'll show you what we mean by a once-in-a-generation opportunity, why market volatility actually presents a window. We'll go back to our dates and we'll set the start date as the end of 2006, so 2006 12/31, and our end date to 2008 12/31. So we're looking at 2007 and 2008. We'll go ahead and enter our two large mega caps, our large media company, and our other big large cap. In this case, remember, we're looking at 2007, so the largest technology companies were in fact Microsoft and Intel. Disney was still Disney. There really were no large biotechs, so we just went ahead and chose GE, which at the time was the third largest company in the world. Again, we'll look at getting long a straddle at a custom timing, 7 days before earnings, closing 1 day before earnings, and taking no earnings risk. And here are the results. For Microsoft, we see 5 wins and 3 losses. For Intel and Disney as well, 5 wins and 3 losses. And for GE, we see 6 wins and 2 losses. And we can see the returns. A 65% return for Microsoft, 45% for Intel. Disney was lower, and GE showed an astounding 171% return. This is what we mean by once in a generation. If we tap on a backtest tile, we can see that during this period, Microsoft's stock was actually down 33%. Remember, we were in the heat of a bear market, but this non-directional trade returned 65%, while the stock was down a third. The average win was 18.5%, and the average loss was just 3% in the heat of a bear market. We can look at GE as well. We can see a non-directional options play returned 171%, while the stock was down 55%. The average win was 27%, and the average losing trade was just negative 7.9%. So you can see the average losses squeezing smaller, while the wins are getting larger, all at the time when stocks are totally collapsing. This is how you survive a bear market. You get rid of stock direction risk, benefit from appropriate and intelligent timing. You are in the market for short bursts of time. This is 7 days at a time, 4 times a year. This is the once-in-a-generation opportunity. To see returns like this, average wins and average losses like this, while stocks are collapsing. And for those of you who are unfamiliar with Trade Machine, we can certainly go stock by stock under the Backtest tab and check which companies have worked best with this pre-earnings straddle. But even more powerfully, we can go to the Scanner tab, go by strategy. Let's look at the NASDAQ 100. We will go down to our pre-earnings scans, and of course, the 7 days pre-earning long straddle. We will sort by win rate, and here we can see that TechGem, EA, Gilead, and then Viacom. Here's Apple, here's Checkpoint, here's Activision, here's Cisco. We can see the best performing stocks in the NASDAQ 100 with the 7-day pre-earnings long straddle. And if we ever want to see the results, we simply tap on a ticker like Gilead. Here are the results over the last 3 years. You can tap on a backtest tile and see the summary information. Over the last 3 years, Gilead has been down 14%, while this pre-earnings straddle has been up 175%. And again, note, while the average win was 21%, the average loss was just negative 4%. And once we've identified the strategies that we want to be alerted to, we can simply add an alert. So we go to the Alerts tab, we will enter EA, we'll look for an alert before earnings, 7 days, enter the email, and our phone number, which is optional. I like to get emails and text messages. I'll add the alert, and here comes the EA alert, 7 days before earnings. As you can see, I already have Gilead, Cisco, Apple, and Microsoft in here. And if you're curious why we have Intuit, Lam Research, and Netflix 3 days before earnings. And what these technical triggers are, that's a different story for a different time. But remember, the trade machine allows for scanning of strategies that have worked across various markets, including technicals and swing trading. All right, let's get to our next strategy. Using our knowledge of implied volatility and how implied volatility before earnings can act as a protection against time decay. And while the results of this strategy are impressive during a bull market, they will stun you during a bear market. The strategy is very similar to what we tried before. We will open the trade 7 days before earnings. We will close the trade 1 day before earnings. We will allow the earnings date and the implied volatility within it to act as a backstop for time decay. But this time, instead of opening an at-the-money straddle, we'll open a long call. Now we turn to the empirical results. First, we'll start during the bull market. Again, we use the NASDAQ 100 and Dow 30 as our study group, 2012 through the beginning of 2018. This is a stock direction risk strategy. This is not direction neutral. The smart part, of course, is that we are decreasing the impact of time decay by using the implied volatility inside of earnings. And by stock in this group, over this 6-year period, the average return was 155%. Let's turn to Trade Machine to see some of those results. And while we can go ticker by ticker and look at getting long a call using custom earnings handling, that is getting long 7 days before earnings and closing 1 day before earnings, it's easier for now just to go to the Scan tab. We will look by strategy. We will look at the NASDAQ 100. We will scroll down, and this time we will look at pre-earnings strategies, the 7 days pre-earnings long call. And here are our results. We can see Microsoft has won all 12 times in the last 3 years ahead of earnings, this 1 week trade. In fact, in that 1 week, the trade has averaged 53%. We can see Nvidia, that 1 week trade has averaged 26%. We can go down the list to find the best performers for this 1 week pre-earnings momentum trade. We can look at some of our favorites simply by going to the backtest tab. And here we can see the results by those 4 megatechs. Microsoft with 12 wins and no losses. Nvidia, 10 wins and 2 losses. Netflix and Oracle with 9 wins and 3 losses over the last 3 years. Doing this 1 week long call using custom earnings timing. One note, if we go down and add an extra layer of protection, which is to put in a 40% stop and a 40% limit on the trades, the empirical results change. We went from a 155% return to a 163% return. And the win rate, that is over the entire NASDAQ 100 and Dow 30, from January 2012 through January 2018, was 60%. Again, having done this research, we quickly go to the Alerts tab. We go ahead and add our Microsoft and Nvidia alerts. You'll note that Netflix has a 3-day alert, and that's because a Netflix 3-day pre-earnings long call has worked better than the 7-day pre-earnings long call, and you would find that in the scanner as well. So we go from backtest to scan to setting the alert. So yes, during the bull market, using the implied volatility of earnings as a backstop to lessen the effect of time decay, the results have been astounding. But the real question is, has this strategy worked during a bear market? And the answer is yes. Perhaps the most incredible part of this strategy is how it has performed during a bear market. If we take the same population and we did this pre-earnings momentum long call, which is a directional based investment, but does decrease the impact of time decay because of earnings, the average return was 38%. And we're looking at cumulative total returns. This 38% in the bear market compares to 62% in the bull market. So the results clearly aren't as good, but they're still stellar. Let's go back to Trade Machine and take a look. Let's go ahead and test the 3 megatechs back in 2007. And we'll add Nvidia too, just for more data. So Intel, Microsoft, Cisco, Nvidia, getting long a call with custom earnings, opening 7 days before, closing the day before. We will look at 2007 to the end of 2008. So this is the Great Recession right here. And here are the results. Intel, 4 wins and 4 losses for a 137% return. Microsoft, Cisco, a 384% return, and Nvidia. And if we tap on a backtest tile, we can see Intel stock was down 24%, while this strategy was up 137%. The average return was 23% during a bear market. And we can even take one of the poorer performers. Let's look at Microsoft. It had 5 wins and 3 losses, but only returned 14.8%. If we look at the details, the stock was down 33%, as we know, and this strategy, even though it was getting long calls, was still up 15%. But let's dig even deeper. Let's change our dates. The Great Recession really didn't start till the middle of 2007. So let's start our backtest period from 6/30/2007 through the end of 2008. Here it is again. We can see the win rates are anywhere from 50% to 67%. Each of the 3 megatechs and Nvidia showed positive returns. Again, we can click inside one of the tiles. We can see Intel. The stock was down 37% in 18 months. This strategy was up 140%. And perhaps the most astonishing of them all, Nvidia, the stock was down 72% in just 18 months. It went from $43 down to $12, but still, this bullish optimism ahead of earnings with a backstop of implied volatility, as we've learned, won 4 out of 6 times and returned a positive 33.7%. Listen to me now. This stock was down 72%. In order to perform in a bear market, you enter only in short bursts of time with a backstop of volatility to protect your options. So yes, bull markets and bear markets tend to create this optimism ahead of earnings, but we have found an anomaly in the market. We have empirically and explicitly tested it and shown the results during the Great Recession and during a raging bull market. Yet again, we navigated the bear market by empirically testing timing based on implied volatility and exposing ourselves to risk for short bursts of time. This is the end of strategy number 2. Now we go to our final 2 strategies. Before we turn to strategy number 3, let's take a look back at that chart of the S&P 500 from 2007 to 2009. Most of our time has been focused on just the period from 2007 to 2008, or even more so, period from the middle of 2007 through 2008. But since we're really looking for volatility events and strategies that work during abrupt bear market and bull market volatility, we should also include 2009 in our test horizon as well. In fact, in 2009, the S&P 500 hit its bottom during the Great Recession and then ripped higher. This next strategy we're going to show you worked better than the 7-day pre-earnings long straddle from 2007 to 2008. But we also want to include 2009 now as we expand our knowledge base. Having said all of that, strategy number 3 looks an awful lot like strategy number 1. But instead of doing a 1-week pre-earnings straddle, we are going to do a 4-day pre-earnings straddle. So open the straddle 4 days before earnings and close it 1 day before earnings using the weekly options. So this is the same strategy but with a tighter time horizon. Because remember, one way to succeed during a bear market is to only have positions in short bursts of time, using empirical data for that timing. And here are the results, using our normal NASDAQ 100 and Dow 30, adjusted per year. In 2012 to 2018, this 4-day pre-earnings straddle returned 40% per stock, which is larger than the 7-day pre-earnings straddle, which returned 34%. From 2007 to 2009, this returned 21% per stock, which is also larger than our 7-day pre-earnings straddle during this time period. But since 2012 to 2018 is 6 years, and 2007 to 2009 is 3 years, it turns out that this strategy performs essentially the same during a raging bull market and a bear market with a bull market bounce. And that is quite unique and why we have saved it for the 3rd strategy. Now, let's go to Trade Machine. And now we can go more quickly. We're going to get long a straddle using custom earnings, opening the position 4 days before earnings, closing the day before earnings. We will look at the same population of companies we looked at before, the two largest technology companies, the largest media company, and the largest biotech. And we can see now for this 3-day trade that takes on no stock direction risk, the worst result for these four companies was Disney, which was 6 wins and 6 losses. But let's take a look. If we go into the details, Disney over the last 3 years has been up 6%. This strategy was up 50%. And remember, this strategy is a 3-day holding period once a quarter, while the stock price is being long for an entire 3 years. And we can see how the average loss is getting squeezed to be smaller. Or Gilead. The stock is down almost 18% in the last 3 years, where the strategy is up 134%. That is a 3-day strategy with a backstop of implied volatility through earnings, where the average loss was just 4.4%, while the average win was over 22%. And we can even look at Apple, most importantly, while this 3-day holding period, once a quarter, has outperformed holding the stock over 3 years, the average loss has been shrunk to just negative 3.8%. Now, let's take a look how we did during the volatile period from 2007 to 2009. That is a bear market and then a bear market recovery. We change our time frame, 2007 through the end of 2009, so 3 years. We change our tickers back to the two mega caps back then in 2007, which was Microsoft and Intel. Disney is still Disney, and as usual, since we didn't really have a large cap biotech, we just go with GE. And you can see, Intel lost 8% during this period with 6 wins and 6 losses, but even in this, the average loss was only 10%. And for the winners, Microsoft during this 3-year period, which saw extreme volatility, was up only 9.5% in 3 years. But this strategy, which has a 3-day holding period, once a quarter, returned 115%, with the average win of 24% and an average loss less than negative 7%. Short bursts of time in the market, protecting ourselves from a large loss. And we can look at Disney. The stock was actually down, or let's call it unchanged, over this 3-year period, while holding a 3-day straddle was up 145% and won 9 out of 12 times, with an average loss of just 6.8%. And the most remarkable, it's going to be GE. GE was down 54% in this 3-year period. The stock was utterly crushed. But this 3-day pre-earning straddle was up 135%. And the average loss was just 7.4%, while the average win was 37%. So we're looking at more than a 5-to-1. This is it. This is how we approach empirical trading. We look for strategies that won during a bull market and a bear market and an extremely volatile market, which includes a bear market. During these bear markets, we're holding positions for short bursts of time, and we use the reality of earnings as an implied volatility backstop, something that always exists whether we are in a bull market, a bear market, or a stagnant market. So we did it. Congratulations. You're now in the upper echelon of options traders with respect to understanding implied volatility, and in particular how implied volatility and earnings with respect to time decay can affect trades during a bull market, a bear market, and a market that goes up and down. Well done. Be powerful.